Hello, Max Drew, friendly neighborhood CPA coming out of Sacramento, California. And today I'm going to talk to you about something that doesn't just affect Californians, but affects people nationwide, and that's taxes for federal. But we're also going to throw in California taxes since I am out of California. If you're in a different state, you might just want to look up the rules for your state tax. But if you need help in California or nationwide, I am available to help, just using California for today's example, since many of my clients do come out of California. So today we're going to talk about different strategies for minimizing taxes. One of the big tax breaks wealthy people can get on taxes has to do with something called capital gains. Capital gains actually refers to capital gains tax rate. It's a special rate that the federal government has given to investors to encourage them to hold on to their investments for more than 1 year. So remember, this only comes into effect if you've been holding on to things for 1 year and 1 day or longer. So the max capital gains tax rate for federal comes in at 20%. So the max regular tax rate is 37%. So if you hold on to the property for 1 year exactly and sell it in 1 year, you could be subject to that 37% tax rate. Whereas if you hold on for just 1 extra day, you can eliminate 17% of your taxes. So imagine you had $100,000 gain on real estate transaction or stock transaction, and you did it 1 day early, and oh my gosh, you had to pay $17,000 more in taxes. Wouldn't that bite? Well, hopefully you do not only your investment planning and tax planning with your investment advisor, but remember, have a good CPA, a good tax advisor, because that can make a huge difference in your net proceeds that you bring home at the end of the year when you're working on your investments. Okay, let's take a journey into the wonderful world of real estate. Now, here's where reality starts to warp. You know, usually when you pay taxes, you're paying taxes because you've invested in something or you worked something to earn money. Well, real estate has a very interesting aspect to it, where generally speaking, we know that real estate increases in value. But when you invest in real estate, the government actually lets you take a deduction on the property as if the property was decreasing in value. So get this, it's one of the few items that I know of, if not almost the only item I know of, where you can actually get a tax deduction for an item as it increases in value. So how does that work? Well, that works when you have a commercial property or you're using something for investment and you're renting it out, say, to tenants, and you're taking that depreciation every year on the property as an expense, even though you bought the property for, say, $300,000, and after about 4 or 5 years, it's gone up to $370,000, and you're having a property that increases in value, an asset that increases in value, but on your taxes, you're taking a deduction as if you were losing money on that. So the government gives you both favorable tax treatment for real estate and also for holding property 1 year and 1 day or longer. So today we're going to talk about what happens when you're subject to a lot of taxes and you're trying to mitigate the tax liability. Sometimes people want to sell their real estate. There are different reasons to sell real estate. One reason people sell real estate is because they no longer want to be in the business of what we call trash, tenants, and toilets. What does that mean? If you own a property, you have to make sure the trash is getting taken out of the property's maintained, for example. So you have to deal with the tenants, the contracts, have to be at their service 24/7 and fixing toilets and things like that. Being a landlord can sometimes be a little bit of a dirty business, but you get the great thing of you get to have some positive cash flow and you get to take deductions on a property or an asset that's actually increasing in value. So sometimes people like real estate because it has the potential to have a positive cash flow, but yet on the books, on tax-wise, it's still showing that maybe you're losing money, breaking even, or something like that with no tax effect. So most definitely people are looking for a net positive cash flow. Real estate's a big item, and sometimes we hold it for a long time, and then we need to sell it in order to get cash. A lot of times when you're selling something, it's an all or nothing situation. And the problem with an all or nothing situation could be, let's say you're going to sell a building that's worth $1 million, Dr. Evil might talk about. And let's say you've owned that building for a long time and it's almost fully depreciated. So you got a lot of expenses in the past. Well, the IRS likes to keep track of that depreciation. And when you sell the building, they're going to make you pay back tax on the cost basis of that building based on how much depreciation you took over the time that you owned it on your tax return. Well, good news and bad news. If you're in a very high tax bracket, the maximum amount of tax you'll pay is 25% for federal income tax. Now, we're not talking about the net investment income tax. We're just going to keep it more simple for our calculations. You're going to pay up to 25%. So if your tax bracket is higher than that, the government cuts you a little break and they say the max they'll make you pay is 25% on your tax bracket. If you sell a property for $1 million, but you only paid $300,000, for example, and you fully depreciated it, the first $300,000 would be recaptured on your tax return at a normal tax rate of up to 25%, and the additional $700,000 could be taxed at an additional 20%, so just 20%, so 17% lower tax bracket on that if you held the property for more than 1 year and 1 day. Today, one of the things you can do is make sure that you do hold anything for at least a year and a day if you're going to sell it to get that favorable capital gains tax rate. Well, if you're lucky enough to live in the great state of California, good news, bad news, property doesn't favorable rate. The capital gains rate is only a federal thing. California will charge you actually the normal tax rate. California has the normal tax rate for gains. So if you have a business property and you sell it in California, no matter how long you've been holding it, this goes with stocks too, California charges you the normal rate. So a lot of people are surprised if they're in a high tax bracket such as 12% in California, if you're a very strong earner, that you could actually end up owing close to as much money in California tax as you do in federal tax on the sale of that property. We've gone over depreciation recapture, we've gone over capital gains taxes, and we've gone over some tax for California. Is there any way to sell a property and get out of the business of trash tenants and not have to pay all that taxes? It's a steep exit price when you have to pay the recapture, the federal tax, and also the California tax, getting up there to be quite a bit. So there is something, a convention that's in the tax law code. It's called a 1031 exchange. The common terminology for it's called a like-kind exchange. Now, a long time ago, you used to be able to sell all kinds of things and never have to recapture depreciation or even pay tax on the gain, because back in the day, you could sell all kinds of business property for something that was similar in business property, and they would allow you to forego recapturing the taxes. But nowadays, they kind of limited more or less to real estate. So for real estate investors, good news, you can still sell your real estate. So let's say you have that $1 million property, and if you sell it at the regular tax rate, you got to recapture the $300,000 at 25%. You got a $75,000 tax on that part, and then the additional $700,000 you're going to capture at the 20% tax rate, another $140,000 there, $215,000 in taxes, and then you add the additional 12.5% almost in California tax. That's going to be $1 million times that, about $125,000. Pretty soon it's like almost $340,000 in taxes to get that gain on the property. Well, for some reason, not everybody loves paying taxes. So if you're patriotic and you say, hey, I want to make sure I'm paying the maximum amount of taxes, don't try to save me anything because I know Uncle Sam needs my money. Gavin Newsom needs my money. So let's keep the money in their pockets. Then don't listen to this next section. But if you happen to be one of those people that for some reason you like to keep the money in your own pocket, you might want to pay attention to this next section because it could be very interesting if you're trying to raise cash from your real estate, but maybe you don't need it all at once. This is a good type of topic for somebody who wants to save money, and they want to sequentially take the cash out of their real estate investment. Because one of the problems with real estate is considered to be relatively safe. It does appreciate, but it's not very liquid. And when you do liquidate it, it tends to be all or nothing. Well, today we're going to talk a little bit bit about something called a Delaware Statutory Trust. A Delaware Statutory Trust allows people to invest in real estate as if they were investing in something like a fund. So a Delaware Statutory Trust, typically they're set up for 1031 exchanges, and you can sell property, and instead of recapturing all the tax effect and having to pay all the taxes, you can convert it in a like-kind exchange into the Delaware Statutory Trust. Now, this is a complex process, and you will need professional assistance in order to do this. So don't think that you can do this on your own without a CPA, an attorney, or savvy investment people helping you. For example, one of the preliminary requirements is that you never receive the cash in your bank account for this transaction. You have to have a third-party qualified intermediary to hold on to the cash from this transaction for you. So one mistake can negate it. There is like a 45-day window for which you need to identify the replacement property. Other qualifications, such as if you had a mortgage on the property and you sell it and you pay off the mortgage, you're going to have to find equally leveraged properties. So all kinds of different things. So not an easy task to under, but if you're looking to try to save maybe $350,000, it might be worth doing a little bit of mental, tax, and investment gymnastics to try to save that money. Let's say you're trying to save that $340,000 on $1 million transaction. What you could do is you could sell that property, and you're saying, well, hey, Mr. CPA, Mr. Investment Advisor, I actually don't need that $1 million all at once. I'd be happy to take it over maybe 4, 5, 10 years. And I may not need any cash right now. I'm good for the next 3 years or so. So what you could do is you can sell this into Delaware Statutory Trust. If you do need to cash flow your money, you will need to make sure that you're investing in a property that's set up, a Delaware Statutory Trust that's set up to be able to convert into a REIT. So it is a complex process, and we do want to make sure that you fully understand how this works. So going from a 1031 exchange, which is a like-kind exchange, to being able to move your money into something called a REIT, that's a 721 exchange. Now, why would somebody want to take a Delaware Statutory Trust and convert it into a 721 exchange? Well, the way this works is the Delaware Statutory Trust is usually an investment property that has a provision written into the investment contract that allows you to actually stay in the same property investment, more or less, but parts of it are converting to a REIT, a real estate investment trust, that will allow you to take a small section of your investment and transfer that into something that you can sell piece by piece. Typically, you're going to see that you're going to need to leave the money into the 1031 property for probably like 3 years or longer. But after that 3 years, you can start converting it at your leisure, piece by piece, into cash. DSTs, a lot of times, they do pay out somewhere between 3 to 7% a year if you're just wanting regular cash flow. But if you want to access the principal and cash out more and cash out the gain in the property value, then you're going to want to have that REIT provision. You need to make sure that's built into the DST contract that you look at when you invest in it. DSTs are not without risk. They can go up in value and down in value. Generally speaking, you might think they're less risky than just owning one property or one building, because you'll own part of an investment in many hundreds of units and you'll just own a small fraction of that. So the odds that something can happen to hundreds of units is going to be a little bit less than something that can happen to just one unit. Kind of like investing in a broad basket of stocks as opposed to investing in just one stock. So it can be seen as having a little bit of diversity to it and a little bit more safety in that way. Okay, how each one pans out individually, that's where the risk comes in. So let's say you had that $1 million and then you wanted to convert 100,000 into cash. Maybe you're trying to put your kids through college and you want your kids to graduate through college with no debt. Wouldn't that be nice? Debt-free college education. Or something other to that fact. Maybe you want to pay off your own home. Maybe you got a mortgage on your own home you want to pay off. After a few years, you could decide out of that $1 million, hey, I'm just going to convert 100,000 of it to pay off whatever you're going to pay off. And then you only need to pay the capital gains on that 10% of what you pulled out, rather than having to pay the capital gains on that total 1 million. Now, as we know, the tax brackets are progressive. So once you get into a higher tax bracket, all the tax for that year is going to be at that highest tax bracket. If you're cashing out $1 million, the first $500,000 brings you to the highest tax bracket. Then additionally, you're going to be in that very high tax bracket. So if you can keep your capital gains in the 10 or 15% tax bracket, and your California tax rate maybe a little bit closer to the 5 or 6% tax bracket, that could be the difference between paying 16% tax on a property versus paying possibly 20% capital gains at the top rate, plus the California capital gains rate. Well, the capital gains rate there, the regular income tax at 12%, can be the difference between paying 32% tax on your property gains or maybe closer to 16%. So you can cut your tax bill in half with these effective tax strategies. Now, you think about it, 16% on $1 million, that's going to be, $160,000 in savings. If the strategy works for you, which it may work for you, or if you want to find out if the strategy works for you, consult your CPA or investment advisor. If you're looking for a CPA or investment advisor that you can trust and you like this presentation, feel free to contact me, Max Drew, your friendly neighborhood CPA, and I'm also a licensed investment advisor coming out of California. Feel free to contact me. I'd be happy to discuss how a Delaware Statutory Trust and fractional selling of your business property through a REIT after several years may benefit you. Please do not use this as your sole advice for doing this. You must contact the proper professionals and make sure this is structured properly. It is a complex transaction. Do not attempt to do this without professional help. All right, I hope you enjoyed the video today. I'm always looking for ways to help you with your financial outcomes and save you money legally on taxes as strategies are available. Remember, with proper tax planning, which usually happens before the tax return is prepared, before you initiate transactions, you may be able to save quite a bit in taxes and have much better financial outcomes. Thank you for joining me today to learn about how a 1031 transaction and using a Delaware Statutory Trust and converting to a REIT after several years may be a way for you to control your tax liability and also control your cash flow in a way that's going to work for you and have the proper financial outcome that you're looking for your life and your needs. Have a wonderful rest of your week. Hope you enjoyed the video. Take care. Please like, share, subscribe. Looking forward to getting to know you better. Feel free to contact me if you need to. Max Drew, CPA, out of Sacramento, California. Take care. Bye-bye. Follow, message us, or scan the QR code on the screen to learn more.